particular chart is the second in one of the fundamentals of economics. So you'll learn about this in Economics 101. And this looks at, if I were a manufacturer and I wanted to sell a product, then I need to figure out, okay, how much should I sell this product for? Now, obviously, I've got built-in costs, so it's going to cost me a certain amount to make it, but then I'm going to want to make a profit. So the question is, or the underlying principle is that the cheaper something is, the more people will want that particular thing. So, and the more expensive it is, the fewer people will want that particular thing. So, at a very high price, you'll have a very low level of what we call demand for the product. But at a lower price, you'll have more demand for a product. So if we were to put this on a chart, it basically looks like this. So this is what we call the demand curve. And this basically, if you were to map it out on average, it would look something like that in simplistic terms. So that's what, so based on that, I might model around, run some focus groups and have a look and see, okay, how do I actually make this work? What is the right price for something? Now, it's also worth bearing in mind that the more demand there is for a particular product, the more my competitors will want to come in and supply the same product. So then what happens is the amount that I can make is constrained by the capacity of my factory. So other companies come into the market, and so therefore more and more of this product starts becoming available. And as we know, the more of an item that there is, the lower the price that we can fetch for that particular product. And this is what we call the supply curve. And this illustrates basically that point, that the higher the price that I can set for an item, the more the incentive for competitors to supply into the market. And the sweet spot where these two intersect is what we call price equilibrium. So those are just some basic concepts around the supply and demand curve. As I said, fundamental economic theory 101 here. So that's me as the manufacturer. But how do we figure out how much money people have got to spend on a particular thing? So for that, we need to look at the economic flow model that I discussed in my last video. And by way of a recap, this is just the basic fundamentals of the economic flow model. And as I said, if you want to go into more detail, understand exactly how this works, that's in the other video. But for the purposes of this, I want to focus on where individuals' money comes from. So we get it from the labor that we sell to the companies who pay us money in return. They give us salaries, and we can also sell our labor to the government, public sector workers, and so forth. So just based on that, we have a limiting factor in as much as the people can only have as much money as companies are willing to pay them. And this is interesting in terms of what we discussed in the other video, because obviously if you're not paying people money, like if you replace everybody with AI, how are they going, if there's no money in the households, how are they going to buy stuff? So that's an interesting conundrum. But as I said, covered in the other video. So the limiting factor then is the amount of salaries a household. So the collective income of a household is basically what we call the household's buying power. But it's not the only place a household can get money from in order to buy stuff. They can also borrow money from the bank. So this would be credit cards, home loans, vehicle finance, all that kind of stuff, Klarna. And as I've illustrated here, you can see not all the households will qualify to actually get money, to get loans. So, and I'll talk about this a little bit later, but just in simplistic terms, some of the households can access loans. There's a cost for accessing that loan, and that cost is the interest you have to pay to the bank in order to service that loan. But then now that they've got that money, what that means is that they can now use it to buy goods and services. So they could, as I said, use it to buy a house, use it to buy a car, They could use credit cards to go on holiday. Basically, they can use it to buy stuff. So that increases the purchasing power of the households that qualify. And what do we know about the purchasing power of the household? Well, what would happen is if you increase the purchasing power within the household, that means that you increase demand. And what that means is prices of everything will go up. Now, in simple terms, this is inflation, but I've got a really clever way of talking about inflation, which we'll get to later. This all looks fantastic if you are on the supply curve, because you're supplying stuff. It means you can now sell them for a higher amount. And the best illustration of this is houses. So we hear about, the housing market, it's so high. And the reason behind that is very simply is home loans. And if we think about home loans, 20 years ago, they stimulated, they messed around with the demand side by offering people 100% mortgages. So basically, anyone who qualified, you want to buy a £200,000 house, here's £200,000. Over time, that sort of whittled down as the Chancellor of the Exchequer and the Bank of England were sort of like, okay, we need to tinker again because house prices are going up too fast and people are buying too much stuff. So inflation's going up, and household indebtedness is going up, and this is a terrible thing. So they squeezed it down. They said, okay, well, let's just give people 80% of a mortgage on 80% of the value of the property. It's also worth pointing out that the banks themselves, they're also saying, I'm not really sure, if I give you 100%, if I let you buy that house for 200,000 and then you default, can I get my 200,000 that I've lent you back? So the fact that the total value that you can actually put on a mortgage is also a function of how comfortable the banks are that they could recover that if they needed to actually take hold of the property and sell it. So that also factors into that. What we've then seen is that, so we've gone from 100% to 80% to, well, let's tinker with it again and let's just offer them an interest-only mortgage. So there the banks are saying, okay, as long as you pay me interest, I'll lend you the money, but the house remains mine. And at some future point, I'm going to expect you to take out a mortgage and start paying back some of the capital on this. So that means now more of those families, the little purple guys, can enter the market. So what does it do? It pushes up demand, pushes up the price. And it's now got to the ridiculous point where you don't even buy the house itself. You just buy a share of the house and you still pay rent to the bank or whoever the freeholder of that property is. So you're paying interest to the bank, usually, on your percentage value of the house, the portion that you're buying. And you're paying rent to the freeholder. So it's quite interesting. In Afrikaans, the Afrikaans word for interest is rente. So maybe the Afrikaners are a little bit ahead on that one, but like Springbok Rugby team. Anyway, back to our presentation. So, so we've established that if you increase demand, you're going to increase the price. So how do we get stability in the housing market? Well, this is something that we are hearing a lot about at the moment. And this is increasing the amount of homes that are available. So in doing this, what we're talking about is we're increasing the supply in the market. So people keep saying, we need to build more houses, build, baby, build, according to Labour. So we need more and more and more houses. They're right up to a point, but there's an interesting stat that I'll get to later around the supply of houses. But be that as it may, if you increase supply, now there's two intersection points that you can see immediately, but I'm going to come to those just after this next point. The next point I want to make is that what you see is if you increase supply, you do still have an opportunity to increase demand. So what that implies is that we can actually allow, if we increase supply, we allow more people into the market, and it doesn't necessarily affect the original price based on the old demand curve. So to me, that's kind of illustrates that, the banks can get in on it. There is space to increase demand. But really, what you want to be looking at is trying to keep the house prices where they are. if we were to release a whole lot of new houses into the market as it currently exists with all of its overstimulated demand, that means we could actually sell far more houses, but keep the prices the same. So you might look at that and say, oh, okay, that's quite a good win. But you're forgetting all the people that fell off the bus earlier when the prices all went up and couldn't qualify for that credit. They're still excluded from the market. So you're still only selling into the same base, which is pretty much why the price stays more or less where it is. What's more interesting is if you increase supply based on the original demand, so demand absent the intervention of the banks, so just based purely on householders' purchasing power, so the incomes of the people in the house, then you can actually bring the house prices down by increasing supply.